So if we look at the accounting cycle here, during the accounting period, like say we're working on January 1 to January 31, we have the source documents, gathering the source document, and then analyze those source documents and journalize the transactions. Once we journalize it, we post those journal entries to our individual general ledger accounts, and then prepare the worksheet. And once we prepare the worksheet, we will now prepare the income statement and the statement of owner's equity and the balance sheet. But before we can do that, we have to post and journalize the adjusting entries. And those adjusting entries will now be posted to the ledger. So once we're done with that, we're going to prepare the income statement, the statement of owner's equity, the balance sheet. Those are your financial statements. And then the final two process would be journalize closing entries, post to ledger, prepare the post-closing trial balance, and that is your end of the accounting cycle. Normal closing entries are given here, so we will talk more about this. There's also a step or steps in closing entries. So this is the complete accounting cycle. So this is during the accounting period, say January 1 to 31, and then at the end of, say, like depends on your reporting period, say you're performing this every month until, like, say December 31, where you will look for the full year and then perform the final post-closing trial balance for the year, and then repeat for the next accounting period. So it's going to go back again to this. So it's always like, a cycle that you have to go through in accounting. So this is the a quick summary of the accounting cycle process. So when we talk about closing entries, we need to close or zero out revenue, expense, and drawing accounts, and update the owner's capital. So basically what we are closing are only revenue accounts, expense accounts, and drawing accounts. And all of this will flow through into the owner's capital account. Closing entries are made after the last adjusting entry and after the financial statements have been prepared. The reason being for that is once you close these accounts, you are not able to prepare now the financial statements because you closed the account. So before you do the closing entries, make sure you are already done with the financial statements preparation. And then once you're done with these financial statements, then you can perform the closing entries and prepare the closing trial balance. So you will close the drawing, the revenue and expense to the capital. So in your post-close trial balance, the accounts that you will have are just your assets, liabilities, and the capital account, because you already closed these accounts. All right. So let's look at the step. So the balance of, so how do we close? How do we close the account? So if there's a debit balance into the account, like in this example, $870 debit balance, to close this, we have to perform a credit transaction for this account. So we will credit this account with the same amount, and then the new balance, you have a debit and a credit of the same amount, your new balance will be zero. Effectively, you're closing the account. Similarly, when the account has a credit balance, you will close this by debiting this account. So debit 1,400, and your new balance will now be zero. So that's how you close the balance in the account. So that's why I said it's relatively easy, because if you have a balance in one side, you just perform an entry on the other side to zero it out. So here are the steps in the closing process. Step one is to close the revenue account into income summary. So we have to first close the revenue into what we call a temporary account, here, income summary. And then we say that, okay, the second step is once we're done with revenue, let's go to expense accounts and close them to this temporary account, income summary. And now, if you have an entry to the income summary account, you have the revenue and the expense, then you will have a balance in the income summary account. And then what you need to do is close that income summary account, zero that out by putting or transferring the balance of that income summary to your capital account. So income summary is basically uh, the amount that uh, result of your operations, either a net income or a net loss. So the income summary represents either your net income or your net loss, and you will close this to the capital account. So once you're done with these steps for your revenue, expense, and income summary, you put them into capital account. Then the last step to close is the drawing account. And similarly with the income summary, you will close the drawing account into the capital account. So here's the example. So we have the income from tours. The balance here was 23,320. In order to close this account, we have to debit because it has a credit balance, right? So we have to debit the income from tours with the same amount and then credit the income summary. So this is your income summary account, and that income from tours represent your revenue. So to close again the revenue account, you have to debit the revenue account and credit the income summary. That's step one, closing the revenue. Now we're going to close the expense accounts. So expense accounts, normally they have a debit balance. To close the debit balances, you have to credit them. So credit the individual expense accounts and then debit the income summary. So as you can see, the debit in your income summary represents your expenses and the credit represents your revenue. So that's step number 2, is to close your expense account. And then if you look at your income summary, right, you have the revenue that you close, you have the expenses that you close. In the end, you have a balance of 16,796 credit balance. Your revenue is larger than your expense. So 16,796 represents your net income because revenue is higher than your expenses. Now we need to close the income summary account. By closing the credit balance of 16,796, we have to debit income summary with the same amount and close it to the capital account. So originally your capital is a balance of 95,200. You perform the closing entries for income summary. You credit capital 16,796. So you know that this is a net income because as you can see, it increases your capital. You have a beginning of 95, closing of 16, so it increases your capital account. But let's take a look at it if, say, you have your expenses is higher than revenue. So revenue was 2,400, you close this one out, you close your expenses, the amount was 3,000. Now, the balance is a debit to your income summary. In order to close the debit balance in your income summary, you have to credit that. So your closing entry would be a credit to income summary and debit to your capital. So the 600 balance here was a net loss because expenses is higher than revenue, or revenue is less than your expenses. So your operations incurred a net loss of 600. So you're debiting here your capital, thus reducing it from the original balance of 42,000. So net loss reduces your capital account. So, and the last step for the closing entry or closing process is to close the drawing account. If we look at the drawing, the normal balance for that is a debit. So to close that, we need to credit the drawing to zero it out and then debit the capital. So that's your drawing. So when you look at your capital, you have the original balance, you have your net income, you have your drawing. So the balance in your capital is 108,496 in this example, and the drawing reduces your capital balance. Okay, so those are the 4 steps. So this is how it looks like in the journal entry format. So your general journal shows the debit to income or income from tours or revenue, debit to revenue, credit to income summary to close the revenue account. That's step 1. Step 2 is debiting your income summary and crediting all your expenses to close now your expenses. And step number 3 is closing the balance on your income summary. It has a credit balance. Now we're debiting income summary and crediting capital. That's step number 3. And then step number 4 would be closing the drawing account by debiting the capital and crediting the drawing to zero out the drawing account. So that is the complete step in the closing process. So if you're doing the closing entries for manual accounting process, but most accounting system or accounting software like QuickBooks or other accounting system cloud-based applications, they automatically update the capital account, so you don't need to perform any closing procedures. In most of the accounting system or accounting software. Okay. So once you're done with the closing entries, you just need to post those closing entries and then prepare the post-closing trial balance. So you will see in the account once you post those transactions, like closing entry transactions, you will see here on your post-closing trial balance the remainder of what accounts are left. So you have the assets, the liability, and the capital account. So those are the remainder accounts in your post-closing trial balance. As you can see, in the post-closing trial balance, you won't see any revenue, expense accounts, and the drawing account, because you already closed them. So once you close this one, this will now be your new balance in the next accounting period. So you're gonna bring forward this balance as your beginning balance in your next accounting period. We refresh our drawing, we refresh our revenue and expenses. It's gonna go back to zero. So you're gonna start fresh for those accounts in the new accounting period. Okay. So we remember we close those accounts during the end of the accounting period, and then reopen it, by bringing again the balances for your assets, liabilities, and capital. And then the drawing, revenue, and expense would start at a zero balance. And that's, that we will measure again for the new accounting period, where we will perform again the accounting cycle. So I guess, that would be chapter 5. And let me just do this one here.